Last year, growth surprised on the upside thanks to the very strong US consumer. This year, growth should remain about the same. The big question is obviously what will Donald Trump do? As regards budget, he will need to negotiate with the US Congress, so it will probably take more time. The question today is about inflation. After a big slowdown in inflation, will we keep slowing down towards the central bank targets, or will inflation remain too high? The general view about Europe is quite negative because of Germany, because of the industrial sector. But 2025 will probably be a year of acceleration of growth in Europe. The consensus expects growth going from 0.8 to 1%, but we could have upwards surprise thanks to the consumer. Consumption is growing much more slowly than the income of households, so we could have a catch-up effect. In Europe, the labor market remains quite tight, and so, in the end, we could have a question about inflation. Last year was complicated for the Chinese economy. Troubles in the real estate sector led to downward pressure on domestic demand. That was compensated by net exports. Obviously, the trade war will have probably an impact on net exports. So the Chinese government needs to prop up domestic demand. We had some announcements. We probably need to have more announcements to have a stabilization in Chinese growth. The US election has added some uncertainty to this economic environment. Nevertheless, within fixed income market, we think that credit should offer good performance over the next few months. Within equities, we think that the current level of economic growth should be supportive of earnings growth. After 2 years of very strong performance, the US equity market has reached historically high level of valuation. Earnings expectations are also very optimistic, so we remain more cautious on US equities than on other equity markets. Overall, we remain confident and find a number of investment opportunities in both credit and equities. We'll keep a close look to economic data and adjust asset allocation if needed, depending on it.
Many investors view the new American administration as negative for European equities because of concerns around tariffs. But this view does not take into account certain positive aspects. The most important is that European companies now generate 26% of their revenues in the US, so they can benefit directly from a higher growth in this country. It's also important to know that their local production in the US has strongly increased in the last decade, and this local production will not be affected by potential tariffs increase. European companies with a significant exposure to the US are currently trading on average with a 30% discount compared to the S&P 500, despite having higher earnings growth. So we believe this is a great time to consider investing in European equities.
We still see attractive yield on the bond markets, especially in credit, with yield above 3% in the investment grade segment and close to 6% in the high yield market. It is also worth noting the very positive trend in the financial subordinated debt market. There are also technical factors supporting the bond market, especially in Europe, where the ECB is expected to continue easing monetary policy in 2025, and where inflows into the asset class remain very positive.